All right. All right. Welcome everybody. I've got a interesting topic today. I've got Ralph Pence here on our podcast today, and former chief actuary, former regional director with Penn Mutual, former you could say president of Advisors Resource, I
Oh
guess.
yeah.
Uh, Worked for Nationwide for a while, worked for a lot of different companies actually. And I wanted to have Ralph, who's my father, I guess, obviously. We look somewhat similar and we have the same last name. Uh, so I wanted to have my dad, Ralph, on because I was talking to an advisor that we work with, and his client ran into another advisor and was really just, he had put a policy in place, an IUL, and this other advisor was hammering our advisor on, like the commissions that he made and the fees in the policy. And you and I got to talking about it, and there's really some interesting reasons as to why it's structured that way, how they price the products. And I thought it'd be interesting to have you on for that reason. But I guess before we get going, maybe you can tell or share, because I know obviously I was there for most of it, but you can tell me like the like before you got into being a wholesaler, before you were on the distribution side, what brought you into being an actuary and what was your career path? Because I think even that's somewhat interesting, you actually I forgot about the trust company. You were the president of the trust company for a while. You now you have a pizza franchise.
Yeah. Yeah.
So it's you've had a somewhat non-traditional career. I shouldn't say had because you're still among the living.
Yes, and knee deep in the dough.
Yeah.
Absolutely.
Yeah, right. So yeah, maybe share a little bit about, okay, why did you even become an actuary to begin with?
Yeah, that wasn't my original plan. I mean, I really started out wanting to be an engineer. I thought of that being an exciting career, just building stuff or, being an engineer. I knew I had my favorite subject was math, but through the engineering process, I realized that you had to take chemistry and physics, and I hated those classes, especially chemistry. But I love the math, and so when you get into an engineering track, you take a lot of math, and it turned out I was closer to a math degree than the engineering degree. Uh, but as you talk to counselors, there's not a lot of options for math. I mean, I could be a
Yeah.
math teacher, and then I heard about this actuarial thing, so it was really quite by accident. But I took the actuarial exams, and I found that to be an interesting profession. And the more I learned about it, it's like being the engineer of a insurance company, but instead of building a physical product, you build a contract. And there's a lot of the same qualities that an engineer does when you design contracts. It's like designing a building or anything else. You've got to make sure that it's structured properly and you create win-win for the company and the clients. And
That's a
that's
good
what
point.
got me to that point. So that led me to my first job as an actuarial student at Columbus Mutual, which is now Columbus Life, and then of course I had a long career at Nationwide.
Yeah, you were at Nationwide for a while. They changed the logo at least twice while you were there, I think.
Oh yeah, yeah. They're back to the good logo.
Yeah, right.
Yeah.
That's a good point about actuarial sciences or whatever you want to call the field, that you're kind of engineering in life insurance, it's a financial product, but I guess with actuarial scientists, you could have been like a PNC pricing person or somewhat adjacent to life insurance, right?
Yeah, it could have been, but the job I had at Nationwide, I rotated through their departments, and life insurance is what I had more of a passion for it.
Oh, okay. So
And
at Nationwide, you work for the PNC
no,
department?
never the
Oh, you
P&C
didn't.
side, but they had a pension department and a annuity department, et cetera. And
Oh, rather than going towards the annuity, you went more towards the life insurance.
yeah, I found that more interesting. There's more moving parts to life insurance. Not that there isn't on annuities, but at that time, there wasn't a lot of innovation on annuities that there is today. But I found the insurance more challenging, and I focused on product development and
Yeah.
was designed insurance products.
So nationwide, I guess at the time, what what life products were you working on at Nationwide?
The well, they had the whole breadth, so I did design a whole life contract, but our biggest focus, this is back when they came up with one of the first companies that had outside funds in their variable products. It was called Best of America, and that brand was very popular. It's sold a bunch of annuities. It was like the number one or number two on the variable annuity sales, and they started a variable life side, and that was the product I spent most of the time on was the VUL product.
Yeah, I mean, I remember as a kid seeing the logoed Best of
Best of
America
America, yeah.
stuff. And then actually I might have seen it more when we moved to Texas and you became I don't know what the title would have been, but you were sort of the wholesaler. So you got out of being in product development and actually took this op. What made you
It,
decide to do that? Because that's a crazy transition.
it would appear so, yes, but my
It would appear so. What do you
yeah,
mean?
my ambition while I was an actuary was to be a president of the company. That was my goal. And I rec
So you were there. How old were you at the time?
oh, I was well, certainly in my 20s, like 28, 29.
So
So,
you're like, okay, I want to be a president of an insurance company.
right.
So I'm getting this actuary thing figured out. So maybe I'll go do sales.
Well, I realized that the people that were in the executive conference rooms were all had multiple disciplines. They didn't just
Okay.
do one thing. And so I figured if I could learn more than just the actuarial side, which the actuarial side is quite extensive. You learn a lot about how everything works.
All right.
I felt if I could get some sales experience, that would sort of launch me into the ability to ultimately get into that
Like upper management.
upper management. Yeah. And so I did a stint of a wholesaler in on the very only product was variable life, and it was a 8 state territory, and it was a lot of work, a lot of fun. I learned a lot, but I still had that desire to somehow get into that senior management and ultimately run an insurance company. That was my goal. Uh, an opportunity came up to go back to Columbus, which I took, and I actually started there. They had an offshore company that I actually helped them get off the ground and did that, but then got recruited away to Penn Mutual to be their chief actuary. So that's how I got to be the chief actuary.
The chief actuary at Mutual.
Yeah.
So what does that even mean? What is an offshore insurance company?
Well, it was to sell financial products to non-resident aliens that were in the country.
So like
So
foreign
for
nationals, like
foreign
the
national,
foreign nationals
it's
that
foreign
you.
national business. Yeah,
Okay.
yeah, and they felt that the brand of Best of America would be well suited for that particular marketplace, and that was probably the most challenging job I ever had because I had to, well, I guess act like a president, bring everything together and including distribution. And it was difficult because I had no authority over all the resources, and yet I had to bring all the resources together. That took a lot. That was a big effort.
President in name only,
It
I
was
guess.
definitely a name only. But the actuarial, the chief actuary job at Penn Mutual was attractive because that to me was a step in the right direction of getting to that goal of being the president of an insurance company.
Well, yeah, definitely. Like you were kind of if you think about well, even think about American National, right? Like Tim Walsh, I don't know if he was somewhere in the actuarial department and ended up becoming president at American National, right?
Yeah, definitely. Yeah, yeah. There's a history of actuary. I mean, it's either the head sales guy or an actuary tends to run
Right.
insurance companies. That seems to be the norm. Although lately it's been more the finance
Yeah.
side. But back then, actuaries it wasn't uncommon for a chief actuary to ultimately get to that point. And so that's what led me to Penn Mutual.
Yep.
Uh,
Moved to Philly. Well, moved to the suburbs of Philly.
Yeah, not my favorite place. No offense to anybody from the East Coast. Uh, they're just a different breed. But one thing,
I guess enough said.
enough said, yeah. I mean, one thing I found out about my dream of being the president of a company was it doesn't matter what you know, it's all about politics.
Yeah,
And even though Penn Mutual was not a huge company, it was quickly apparent to me that I'm not cut out for politics of a company.
yeah.
I assume when someone asks you a question, they actually want what you think, but they want you to repeat what they think. And I wasn't very good at that.
Yeah, that's not surprising.
Okay.
Yes, that's not
Well,
surprising. I probably would have gotten fired as well, so or I probably wouldn't have done well in a career
uh,
corporate job either.
yeah, yeah. But fortunately, as you know, things happen for a reason. They were trying to grow sales, and there was a territory open up in Dallas where I had lived as a wholesaler for Nationwide, and I asked to be transferred. They thought I was crazy, but I think a lot of people thought I was crazy, but ran the regional office and did that for 13 years.
That
And
was kind of your longest job, really.
yeah, certainly was. And it was a really good run. I enjoyed a lot of at that time they treated the regions as if you owned a franchise. They
Yes, that was, I wanted, because we talked about that yesterday. I wanted to bring that up because I think that's a really unique way. And obviously, they're not, well, I can't speak for them, but I doubt they're doing that anymore. I
oh
doubt they're
no.
running it like that anymore.
No. They hired entrepreneurs to run regions. They gave you a lot of autonomy to bring in the sales, and we were heavily involved in product design and marketing, and I really enjoyed that job. And until they started to realize, well, maybe we're paying these guys too much, and we got to rein them in, and that didn't go over too well. So we parted ways in 2013, and that's how I finally became a president and of my own company, so I could give myself whatever title I wanted.
You can be anything you want to be, right?
Yeah, and then that's how Advisors Resource was born.
Yeah. So Penn Mutual, they had an interesting run because so like that would have been I can't remember. So 12 you were there for 12 years. So that was like 25 years ago, basically, right? So
Yeah.
that was 20
Oh,
2000.
2001.
Yeah,
Yeah, 2001
2001.
is when we first opened, came back to Dallas. Yeah.
So what was the because the region was like I mean nobody even heard of Penn Mutual back in 2001 and then they
Yeah.
just now I wouldn't say everybody's heard of them, but they've got a much bigger market share than they had back then.
Oh, sure. When I first started, their only product was variable life, which I was very familiar with my Nationwide days.
As the chief actuary, they had a VUL.
They had a VUL, and even when I came out in the field in 2001, it was a VUL, and they rode that product for quite a while.
So that's what you were promoting as the RD, the
The
regional
regional director,
director.
yeah, yeah. VUL was the main product. Most of what I have always done is accumulation products, so variable life makes perfect sense.
Hmm.
They really took off when they came out with that IUL contract, and they had arguably the best whole life or IUL Index Universal Life product on the market. It had a 2% floor and a 14 cap, and as brilliant as I thought I was at marketing, it could have been that they had the best product.
Well, when you're the single distribution arm of an insurance company that happens to come out with the best new product
Yes,
category,
yeah,
that helps out a lot.
it does. But I'd say we still came up with some good ideas that
Yeah, certainly.
transcended, and it was a lot of fun. Does make it easier, but things change, and competition comes in, and Penn Mutual made a big shift in focus from Index Universal Life IUL to whole life, and
It seemed like that happened almost overnight. It was like because I got into the business in 2010, and you were obviously still with Penn Mutual at the time, and Like it was like IUL for like the first 2 years, then all of a sudden, hey, we got this new thing called whole life.
Yeah. Yeah, I had a challenge of well, I just didn't
Yeah,
promote whole life.
yeah,
And, that certainly led to at least one of the factors of me no longer being at Penn Mutual. But I just can't get behind a product that I don't really believe is the best solution for clients.
yeah.
I think there's always a whole life. I'm not sure what its place is, but if you want a guaranteed death benefit, it's not the best guaranteed death benefit.
No,
And if you want cash accumulation, it's not the best cash accumulation.
it's like somewhere in the middle.
Well, it's like in El Camino. If you want a truck car, then get a whole life.
A
But
truck. What do you mean a car that's not a great car and a truck that's not a great truck?
yeah, exactly. Exactly. I mean, now, I'm sure there might be some application for whole life, but I couldn't, at least the people that I dealt with didn't see it, and neither did I. And it's
Yeah.
hard for me to promote something that, just happens to be the most profitable contract that the carriers sell, and it pays the most commissions to the agents.
You can
It,
say that again, actually, because I think people don't actually realize that it is the most profitable to the insurance company.
it is got the highest profit margin, and the agents, I know the managers get paid more than other products, and it leaves someone out, and that's the client. And even though I represented a carrier and I supported agents, I don't feel good about the client being left out. I think you have to have that balance. And there's no reason not to. You can get paid very well as an agent, as a manager, or a brokerage manager, and still deliver good value to clients. And that's
Yeah.
that's what I strive for.
Yeah, I agree with that. And it's kind of like what you've always said. It's like if you're gonna do the right thing, if you do the right thing, you're gonna get paid anyway. So it doesn't really matter.
It's yeah, exactly.
I mean
And
that's the
at
way it
some
is.
point you gotta sleep good at night.
Yeah,
And
that's
so
that's another good point. Yeah.
yeah.
Yeah, you got to be okay with what you're doing, that's for sure. Now, when you were the chief actuary, was there any, because that was a relatively short stint, was there anything that happened or was there anything that like stands out that was fun about that job, or was it just kind of too much politics, or was anything, I don't know, was
Well,
there anything that you're like really
well,
just
there's a couple things. Well, first of all, I would say is the easiest job I ever had. And the reason is the actuaries are pretty smart people. I mean, they're
right?
they're they're really good, but what they're not good at is making decisions.
Yeah.
And so I would have smart people coming up to me, asking me questions that I barely knew anything about. I would ask them questions, they would answer their own question, and I looked like a genius. And so it was the easiest job I've ever had.
Sounds like ChatGPT can replace that job.
I was the chat GPT of the office. No, it was an easy job. It's not that I didn't enjoy it. Uh, Probably the thing I'm most proud of is there was at the end of the year, the president of the company was talking about cutting the dividends, and as the actuary, I had to sign off on it. But the dividends are supposed to be paid in proportion of the profit of the policyholders.
Supposed to be, right? That's the whole
And
thing.
the whole life block of business, as I mentioned before, is the most profitable. And the whole idea of a mutual company is to return excess profits. And so I did not support cutting the dividends. And so I said, no, I don't think we should. And they kept the dividends the same. And I felt good about that.
Yeah, you should feel good about that.
Well, after I left, they did cut them, but that's a different story.
We'll wait till this guy's gone and then we'll then we'll do whatever we want.
Yeah, yeah. So that was
Why did they want to cut the dividend?
it's if you want to sell new products today, and you need to support it. If I take money from the old block, they might not notice because it's dividends,
Yeah.
and I can make the new products more competitive.
That's
It's basically letting one policyholder subsidize another, and
yeah.
that's something that actuaries shouldn't do. They
No.
shouldn't endorse. I didn't endorse it, but it happens. I mean,
Yeah.
it happens.
Yeah, I mean, I guess you can justify anything like we've talked about. I mean, you can
Yeah.
justify, well, the company will grow and that'll be good longer term. I mean, maybe you can justify it that way, but yeah, that doesn't really seem right.
No, I didn't find it was right. I mean, and you know, the interest rates were dropping at the time,
Yeah,
and maybe the drop after I left was justified. I don't know because I wasn't there,
right.
but at the time it was not justified.
Well, and you know, that's another, I don't mean to turn this into like a whole life bashing session, but that's like another negative with whole life is, you know, at least on an IUL or any UL product, they make an adjustment to the non-guaranteed components, you know about it. The dividend is somewhat
Yeah,
a little bit hidden because it's not like they say, well, your dividend rate was 5 and we cut it to 4.5. It's just, oh, here's your dividend. It's like black box, you
yeah,
know?
it is definitely a black box. You know, I've talked to advisors that say the IULs are too expensive.
Right.
And I said, well, what do you sell? Well, I sell this whole life. You know, you don't have those charges. I said, well, they're in there.
Yeah.
It's just you don't see them.
Yeah.
Uh, you look at the first year surrender value on an all base whole life, it's practically zero, if not zero, which
I'm
is
pretty sure it is. Yeah.
it's essentially 100% surrender charge. Now, there's no IUL that has 100% surrender charge, but that's just one component. It's just built into the design, and it's that lack of transparency is one of the things I don't like about it. You can calculate it, and I've done that before, and you'll find that it's every bit as expensive as an IUL, and it's just less flexible. I don't like the rigidity of the whole life
Yeah.
compared to a universal life.
Yeah, especially in the higher end market. I mean, it definitely, it seems like it'd be more valuable, but again, I don't, I, I don't understand most people's, I mean, people drink the Kool-Aid or whatever, and they like something because they like it and
Well,
they justify it however they justify it, I guess.
the best rationalization for whole life is sort of a forced savings,
Yeah.
and it does promote for more persistent premium,
Yeah.
which is why the carriers like
It's
it
easier to
because
plan if you have persistent premium.
right. And so the people that own a whole life, unless they allowed it to go on automatic policy loans, the people that own a whole life typically have pretty stout cash values at the end. What you see and what you've seen when you talk about some of the older whole lives where the agent wasn't paying attention, client wasn't paying attention, they stopped paying premiums, it goes to automatic premium load. Next thing you know, that you got this thing fully loaned out and it's a tax bomb ready to take off. I mean, you've seen plenty of those cases.
I've personally seen them. You've seen them probably more than I have over your career, and it's like, you know, it like the advice. Like I just was talking to somebody a couple months ago, and it was like, you know, I don't remember the specifics, but it was like a $500,000 tax hit with a $200,000 surrender value,
Right.
and my advice was basically like, well, you got to find a way to pay back this loan, or your dad needs to die in the next 3 to 4 years.
I don't like that plan.
No, that's not like yeah, yeah, you don't want to hear that. It's like, how healthy
Yeah.
is he?
Yeah. I think it brings up another point, and this is probably the sad part about the insurance industry is the way agents get paid, it's mostly upfront. And as a result, some agents, not all, tend to ignore their base, their clients, because they have to get the next sale, and these policies aren't being serviced. Now there are exceptions. I mean, Bill
Yeah,
Ipo, a good friend of mine, he does a very good job of managing his clients, and they don't run into those problems
you need
because
to,
you catch it early.
yeah,
And so having a process where you're monitoring your existing book of business is so valuable. It'll lead to more business because you'll get more referrals
exactly,
and it's doing the right thing. And if you catch these things early, there isn't a bad product.
exactly.
There's bad execution.
Exactly. Or the client didn't do what they promised or whatever, or what they said they were going to do.
Right.
But that's one of the reasons that we spent so much time over the years trying to figure out the best way to track policies. And, you know, we're actually implementing a new software on our portal that will actually track the daily values of the policy.
Yeah.
So I'm pretty excited about that, which I think will uh I think it'll alleviate some of that problem. But you mentioned how the agent is paid. And so back to your maybe actuarial experience, how how are you designing these charges and why is it so front loaded, do you think? And uh like what goes into putting a policy together or putting a
Yeah.
the charges together?
The basics of how you put the charges together is you try to match expenses with revenue or charges. So every year you have a mortality risk. Somebody could pass away, and so you have a charge for that, and that charge should be roughly proportionate to what the risk is.
Okay.
You have administrative expenses that are higher upfront because you've got to do underwriting, and so you tend to have more upfront
Right.
charges. So in a perfect world, those would be matched one to one, but that doesn't necessarily give you the best value.
Right.
And
Well,
mo-
I guess especially in a UL contract.
Precisely, yes. There's not as much manipulation. The manipulation on the whole life comes in your dividend design, and
It's easy. Yeah, you
so
have the
you
guaranteed charges, and then you're either going to give a little bit back or you give a lot back.
yeah, and you'll give a little bit back early or a lot back early, or vice versa.
Right.
And so that's where the creativity comes into play on what is your objective. You cannot design a product that has high early cash values and high late cash values.
Good
And
point.
there's not enough, there's only 100 cents in a dollar, as an actuary once told me, which Captain Obvious said
Yeah, clearly.
clearly. And so the idea is, what is this product going to be used for? If it's going to be used for income down the road, then you're better off having slightly higher charges in the first few years and lower the charges in the later years, just like a, teeter-totter.
Right.
And if I want to raise the later year cash values, if I can get my profit early for the company,
Right.
then they can afford not to have a bunch of profit at the back end. And so
Okay,
that
so that's why you'll see an accumulation IUL or an IUL that's designed for cash accumulation have the chart like over the first 10 years, there's a lot of charges. By year 10, if you funded it right, you're ahead by some amount, but it's
right,
not double, you know?
right. Now you take a COLI product, corporate owned life insurance product. There you are worried about the upfront charges because they're putting it on the balance sheet.
Right.
And there you want to shift it a little bit. Now it's going to be at the expense of later cash values. But that's where you might use the CVAT test instead of the
Right.
guideline premium test, because you can put more cash faster in that design, but it's going to hurt you on the back end.
Because you got to carry that higher death benefit
Exactly,
longer.
which is one of the reasons why whole life, for example, isn't the best income product. It might do a better job in death benefits at age 100 because of the CVAT ratios
Yeah.
that'll drive up the death benefit. So those are the considerations that the actuaries are working with. Uh, the other aspect of the front-loaded expense is the bit, one of the big expenses that the carrier has is the compensation to the agents.
Yeah, the distribution, the
And,
sales.
and so they need to recoup that cost. And, and some of it are, a big chunk of it might be the surrender charges to reimburse for that. But that's an optional charge. If you keep the policy in force, you never pay that charge.
Right. Yeah, it'll go away. I mean,
Exactly. So another misconception, which is to the point of the situation we talked at the beginning,
right.
is people think that the clients think that the policy is paying the commissions, and that's not the case. The insurance company is investing in this sale, and they invest it by paying an agent to do all the marketing and all the selling. So they've outsourced it to agents, independent agents,
Right.
and therefore that they have an upfront cost that is way higher than what all the charges are. And then they get paid back through profit. So they're just amortizing that off.
So in theory, the insurance company in the first year is actually maybe spending is the right word, spending more than they actually got from the client as far as premium.
Maybe
Certainly
it's certainly it's going to be probably 1.5 to 2 times the first year premium is what they've spent
from underwriting
from
comp.
underwriting costs, getting it on the system, paying the agents. All of that is more than what the premium's coming in. So clearly, the client isn't paying that.
No, or else they'd have to write
But
a bigger
a bigger check,
check.
right?
Yeah.
So
Well, and I
whether
guess furthermore, they also have to pay for all of the declines that were underwritten, all of the not takens, because they have a
absolutely,
material cost with that as well.
well, yeah, there's a lot of work that goes into a lot of upfront expense that the carriers are bearing, and then they get repaid over the life of the contract.
They have to eventually,
Yeah,
yeah.
and another misconception is this idea that because you're paying an agent, you're getting an inferior product.
Yeah.
Now,
I hear
uh,
this all the time too.
it's a fallacy, and here's why. If I, as an actuary, were designing a contract that didn't have a surrender charge, I would have to build in margins to cover the persistency risk, the lapsation. If there's not a barrier for somebody to keep the policy and be resold on that anniversary, then the lapse rates will go through the roof. And the price of that persistency is way higher than what you're paying an agent. And that's why you don't see fee only life insurance products. You can't design one that's better than one where you're paying an agent.
That's a really good point. And I guess furthermore, it creates an investment problem too, because they're investing. I mean, they're not like just taking the money and putting it into a bank account. They're taking the money and they're putting it into bonds and long-term instruments.
They would have to invest so short that you wouldn't get the
You wouldn't
return.
get any yield.
Yeah.
Yeah.
Well, it would, again, if it worked, there would be nothing more that an insurance company would want to do than cut out agents and go direct to consumer. But that just doesn't work.
Yeah. I mean,
They've tried. It just doesn't work.
well, and it seems to be the trend anyways that they're sort of leaning into, not all companies, but a lot of them have leaned into like distributors like us,
Right.
they're not. Because I thought, probably like you thought, that the BGAs eventually are going to go away and the insurance companies will do the sales function. But I guess they've just decided, well, it's like what Penn Mutual did, right? They
Right.
hired an entrepreneur to run
Yeah.
their distribution, and it's kind of what it's almost the same analogy to the IMO, BGA, whatever you want to call it.
Yeah. It is extremely expensive to hire and train new sales people
Tell me about it.
in this industry. It's cost prohibitive,
Right.
and very few companies are still doing it. There's a few mutual companies that are still doing it, and they've managed to do it, but it is very expensive, and I think ultimately it's going to be outsourced maybe 100%, as almost all of the mutual companies are now doing brokerage business.
Yep, we've got what is it? New York Life, Mass Mutual.
Penn Mutual,
Yeah, Penn Mutual now. I mean, they all have sort of they're going through various intermediaries.
Securian
Yeah.
also.
Yeah, they actually use, well, we were just up
Yeah,
there. They used to have a whole like career agency force and they got rid of
they
it.
just sold it. Yeah,
They got rid of it because it was too expensive, I guess. Yeah, I
yeah.
mean that's what they said to us. Which is actually really interesting. Now, I guess back when you were the wholesaler at the regional director at Penn Mutual, there was a career agency side, and that's actually where I got my start. But
Hmm.
it's kind of interesting that I guess how did they afford all that stuff? Because they had the independent distribution, and then you have like somewhat competing career shop.
Well, I think initially it was a loss leader for them.
Yeah,
I don't know how
seems like
prevalent.
it's grown.
Yeah, I don't know how prevalent it is or how they're doing, but financially it was a drain
Yeah,
in the early days. They just the career was way too expensive. They've done a lot of consolidation of those offices, and maybe they've gotten some synergies, and maybe with technology, they're able to do it with less office space.
I don't know. Yeah, I don't know. I mean, it's Who knows? I'm not sure how they would do that. Yeah,
Well,
that's a
maybe
good.
they're selling a lot of El Caminos. I don't know.
So, so you kind of mentioned balancing the profitability for the company and the fairness with the client or the policyholder. You mentioned the CVAT versus guideline premium test, and I talk about this sometimes with agents, especially in the context of the whole life conversation. But for everybody else out there, maybe a high level overview of the underlying difference between this, because this is a test, like a definition of life insurance test.
Yeah, yeah. So the CVAT test, it's basically driven off of the it's called a net single premium, but how much money does it take to carry a death benefit all the way to maturity?
So could you do a single premium into a CVAT and not create a MEC?
You cannot do
You
that.
cannot do that.
No,
Okay.
because the other criteria is the 7-pay premium.
Okay, so you have the seven pay
So
test
the
as
seven
well.
pay test works for both. So that's one limit. But there is no premium limit outside of that 7-pay amount. You could put in as much premium as you want and it will just drive more death benefit. And so as your cash value grows, they check how does that compare to how much money you would need on a one-time basis based on your age to carry it all the way out. And so
Oh,
if you had good performance, you're going to drive more and more death benefit. And then your
so
cost of
this is
insurance goes
way after issue, right?
way,
Like
yes,
performance is 10% a year and you're 30 years into the contract. It's then saying if it's $1 million, okay, based on your mortality, 1 million times whatever ratio, it needs to be 2 million of death benefit.
exactly. It'll drive death benefit, which for some scenarios
Could be a
that
positive.
might be a positive. And when you look at life insurance as an asset class and you would rather, you got money in a bond portfolio, if you moved it to a whole life chassis or anything with the CVAT,
So it could be a CVAT
could
IUL in
could be a
theory.
CVAT IUL, it could be a CVAT VUL, but if you did that, then if this is money you'll never touch and you're transferring it to your family, that might be a better solution than a guideline premium test product.
Certainly more tax efficient than the bond portfolio.
Certainly, certainly, yeah. So there's where I can see possibly a whole life design. You don't get a lot of those requests, but
No,
it's
not
possible.
really. Yeah.
Now, the guideline premium test it says the most premium you can put in is based on this calculation that includes the guaranteed expenses of your actual policy. So guidelines will be a little different based on the company, whereas the CVAT is based on guaranteed more COI rates, not charges.
So if I design an accumulation IUL where the guaranteed like max charges and the 0% return lapses extremely quickly, that means my guideline premium test will have a higher premium limit per the death. Like I could get more premium into that
Yeah,
policy.
yeah, you could.
So is that why when you show an advisor or actually probably a client, when you show somebody a IUL illustration like that, the guaranteed ledger looks like crap.
Well, I mean,
It's part
crap,
of the design, I
it's just
guess.
it's part of what you're designing. I mean, the dividends on a whole life are not guaranteed,
Right.
but there's very few companies that don't pay dividends
Yeah, good.
because there's a lot of margins in those charges. Most companies that you deal with have never increased their cost of insurance charges.
Right.
And so the amount they're charging is a better guess of what's the right number than the guarantees. The guarantees are there for insolvency purposes. So
Right.
the margins are incredibly high. So anybody that looks at the guaranteed side and said, "Oh, this is terrible," the probability of that happening is exactly zero. It'll never happen.
Yeah,
First of
especially
all,
with a highly rated company.
well,
Even maybe even with a not highly rated company.
the states have to approve your charge increases, and they're not going to let you go from a fraction of a guarantee all the way up to the guarantee. And it's certainly going to take time for them to get that through all of the 50 states.
Right.
And so it's unreasonable that you're going to get zero return for 20, 30 years and the maximum charges. I think it'd be better off to look at the currents at a lower rate
which
than the guarantee.
some of these I don't know when they started doing it, but I guess in the last 10 years they've had that midpoint illustration, which is usually like the fixed account
Yeah.
on it, and that is probably more of a reasonable ledger to look at if you want to look at like, okay, what's I don't want to use the word guaranteed, but what's like
Yeah,
worst case scenario
well,
maybe.
sometimes it's with IULs, I think the midpoint is almost too punitive.
Yeah, maybe so.
Because of AG 49, the max illustrated rate is already conservative.
It's pretty dang conservative, right?
So now I'm sure you still do the calculation, but you can back test some of these indices and say what was the worst 20-year period over all these different scenarios. That's probably a better number, which is probably in between the midpoint rate and the current crediting rate. Is probably a more reasonable, hey, this is probably the worst case scenario. Now, obviously, there's no guarantees,
Yeah.
but I'm pretty darn sure it's never going to be zero over 20 years. Never has.
You probably have bigger problems than what your insurance policy's doing if that's the
That is
case.
that is a fact. Yeah.
Yeah, I think on a 10 cap, like a zero floor and a 10 cap on the S&P, like the worst 20-year period is probably somewhere around 6.5. It's probably not. I mean,
Right.
it's pretty good.
Right. Well,
It might be a little lower than that, maybe around 6, but
yeah,
it's not going to
yeah,
be 4.
right, which is what some of those midpoint rates are going to be.
Yeah, that's exactly right. And I think that's another problem with maybe how insurance is typically sold, right? Like we have these illustrations where the, the interest rate is the same every year, and then we have a
Yeah.
distribution that's the same every year, and that's not really how people use insurance.
No, they never do. It is unfortunate that the illustrations were designed just to show you how it works,
Right.
not how it will work.
Right. Yeah.
Not this is the answer. This is just representative of if you got this, it would look like this, but you're not going to get this.
No.
It's never going to be the same rate year in, year out. And you're never going to pay the premiums on the exact same day,
No, that's
year in,
another
year
thing. Yeah.
out.
Like if you pay premium, like if you buy an annual premium 100,000 and you pay the premium 2 months late, which you can, and that's fine, and it's not going to impact the performance that much, but the end of year value is going to look totally different than if you paid it right on the day that you're supposed to.
Exactly.
And
Yeah.
in fact, they have the timing risk too, or not risk, but the timing problem with IULs where if I put the premium in today, which is the 16th of May, then my segment doesn't depending on
Mature.
the
Right.
company, but it's not going to start till June 1st. And then it
Right.
matures June 1st, 2026.
Yeah. I would say that the most complaints I would get would be the first anniversary of someone that hasn't sold a lot of IULs
Yep.
because they didn't know how to explain you have an accrual of a crediting rate that isn't in there yet. And it's so much better to wait until that comes in and then
Yep.
do your review
Yep.
and say, here's your annual statement, but here's what it looks like today.
Or almost tell the client like, hey, you just got your statement. You're going to get a credit in 15 days or whatever it is,
And it's
in
going to be
25
this.
days,
Yeah.
and let's visit then.
Yeah.
I wish if any carriers out there are listening, I wish you guys would do, and some I think are starting to do it, but I wish you would do almost a new statement every like time the segments get credited. You know what I
Yeah.
mean? Like almost like I mean, that would be a lot of paper. That might be a lot of expense, but the value would be pretty
Yeah,
big.
yeah, I could see it being pretty elaborate when you've got multiple funds.
Yeah, or if you're paying
And if you're
monthly,
paying monthly, that could just be outrageous. And there's some segments that mature every 2 years. So you got all
right?
kinds
That'd
of
be
complexity.
yeah, which that's a little hokey in my opinion, but the 2-year maturities.
Unfortunately, how it illustrates drives a lot of what gets shown, not reality.
Yeah, remember that one, not to bash any company, remember that one Lincoln product back in, I don't know if that was like what, 7, 8 years ago, where if the index was positive, you got an extra bonus. And then on the illustration, you got that bonus every
Well,
year.
it was
What was it? It was something like
if
that.
if you had two positive years in a row,
Yes,
you
that's
got
what
an
it was.
extra bonus, and it would show bonuses 20 years in a row because you did a level rate. And the probability, or at least the back testing, said that that only happens half the time. 12 out of 20 years, you might have 2 years in a row.
Right.
And that to me is just totally disingenuous.
Yeah, it's a little bit crazy. I mean, it's well, that kind of goes back to AG 49, AG 49A, AG 49B
Yeah.
from like a actuarial standpoint or from a I don't know, maybe even an insurance salesperson or insurance wholesaler standpoint. What do you think about those
I,
revisions?
I think they took a problem, which was some deceptive illustrations.
Yeah.
And one example, I'll give you an extreme example, is you would have an illustration system that would allow you to illustrate, say, a crediting rate of 6, but you could run your loan rate, what you're getting credited on loans, at 7 or 8. And so you had this huge arbitrage that was buried in the way it was illustrated.
Okay. Yeah, that's a pretty nuanced thing because so it says 6% on the illustration, but then buried beneath there, it's like on the loaned out portion, we're crediting 7,
Right.
which just makes your loan spread that much bigger, an
Yeah.
extra point bigger
Yeah.
than it should be, which makes the product just sing when you show distribution.
Yeah, at that time, it was more like a 500 basis point swing
Yeah,
because the max crediting rates weren't suppressed
right,
and they could credit like 8 or 9%.
right.
And so the industry looked at that, and instead of addressing the abuse in the illustration system, they said, well, we'll just change everybody and illustrate it like this.
Right.
Now, the drivers behind that happened to be mutual companies that were getting just crushed in sales because the accumulation side on an IUL at 9% was killing the whole life. So I think they created unintended consequences,
Yeah.
and these, creative actuaries would come out with these bonuses that would circumvent the restrictions. And then when those got addressed, they came out with different bonuses, and they made something that was 100% transparent to something that took literally an actuary to figure out what the heck is going on.
Yeah, you got to be really careful of comparing income to income, I think, because the current trick, quote unquote, trick is like an interest credit of a reimbursement on the loan balance,
Right.
basically, and that's what almost and other bonuses that kind of just juice up the loan spread, and that's
Yeah.
the current deal. I mean, and it's like the company standpoint. I mean, I get the companies. It's like, okay, do we want to be competitive or do we want to be straight up? And I think that, well, speaking maybe going all the way back to actuary time, but this wasn't even around back then.
No, no, it
It's
wasn't.
like, man, that must be a hard thing to balance for them currently.
I think that's where the industry needs to come together, and maybe the BGAs need to say we want transparency in design instead of chasing what looks the best. I mean,
That's a really good point.
There,
Yeah.
there have been plenty of times where I'm looking at an illustration and I'd say product A looks better on paper, product B is better and
Yeah.
will perform better, unequivocally will
Yep.
perform better than product A, but I can't show it because of the restrictions.
Yeah.
And that's where it gets frustrating.
What do you think the agent's going to sell? I mean, do
Well,
I try to explain that to the client? Like, look, here's company A, here's company B. Company A, you get this much. Company B, you get this much.
well, my recommendation always has been and would continue as an agent, educate yourself. And why bother showing company A if you don't believe in it?
Good
Or
point.
show it and say, this one looks better, but here's what I don't like about it. Here's what I like about this one. And I think your clients would appreciate that open and honesty. And there's not going to be any client that's going to say, no, I want the deceptive one. It's never going to happen.
Yeah, I mean, I guess that's another thing that's kind of disappointing about the industry, I think.
Well, there's not any industry that doesn't have these types of issues.
Good point.
And so
Yeah,
All you can do as a brokerage service is to give the best information you have
yeah,
and let the people you're working with decide how they want to deal with it. And I mean, that's the best thing. I mean, there certainly were products that I wouldn't represent.
yeah,
Uh, regardless if the agent wanted to sell them, it's fine, just not here because
yeah.
I don't believe in it. And but it's let them decide, and the clients will usually take the agent's lead,
They'll
advisor's
almost
lead.
always take it, yeah.
Yeah.
And that's, you know, you get people that say all the time, like, oh, I need a like this company because the client recognizes the name or whatever. I can tell you, and you can probably say the same thing. I can tell you how many times a client was like, you know what, I've never heard of that insurance company. I don't think I want to move forward on that.
Yeah, that never happens.
I don't know why people bring that up as an objective. I hear specifically with like a lot of people will say, "Oh, I use Pac Life because everybody knows the name." I'm like, "Hey, what?"
Well, that's a confidence issue of the
Probably.
advisor, and I think your job is to educate them and tell them why you recommend this product
Yeah, that's
over another one. I mean, that's where you can add the most value is
definitely.
to say, this is what I recommend and here's why.
Yes.
And it could be two or three. These are the top two or three, and these are the reasons why I like them. I mean, I think that's probably the biggest value add I was able to bring, and
Yeah.
some of it was based on just the experience of designing products.
Yeah, it's gotten more and more complex, it seems like every year. The other thing is a lot of these volatility indexes that have come out over the years, which, is I guess it's somewhat better to have more options for indexes than just the S&P 500, but some of them haven't really the engineered one, the more engineered they are, the worse they seem like they perform.
I,
Um,
I think not that I understand volatility indexes, but if I did, I think I could design a great one if the criteria was what works best over the last 5 years.
yeah.
With that kind of hindsight, I should be able to design one that
Well, yeah.
works pretty good.
If
So
you're targeting a specific volatility amount for a specific return so that you can hedge it for this cost, and I just have to make it back test over the last 20 years, that's not really.
yeah, I think that's
I
the
probably could ask ChatGPT to do it right now and it would do it in
I think
35
that's a risk.
seconds.
I mean, I was always a big fan of the 1 year point to point. It's easiest
It's
to
pretty
understand.
forward.
It's going to be the most efficient price wise for hedging. I mean, everybody understands that, and the clients understand it.
Yeah.
But I'm not opposed to any of the other indices, and maybe that provides some diversification. But
Yeah, there's a few neat ones out there, and obviously at your time as an actuary was before these, and I think the actuaries do get involved in designing some of these
oh yeah, definitely.
and trying to figure out, okay, what's our hedging budget? How are we going to do that?
Hmm.
Which, that was always kind of fun to talk to some of the investment slash actuarial guys as to how they're hedging for some of these strategies. I always thought that was interesting.
Yeah, yeah, it definitely is more complicated than it used to be, but I don't know that it needs to be that
No,
complicated to provide value. And
no.
I'm not so sure that 20 years from now there's not going to be a big difference between some of these different strategies.
Yeah, you're probably right, actually. And really, the S&P 500 is probably going to be S&P, NASDAQ, because a lot of them have NASDAQ now, which
Sure.
is somewhat interesting. So, what's your opinion on some of the companies that have suppressed the cap over the last, however long?
Well, there's
Because I,
two.
I mean, I can think of one that you know pretty intimately, but there's a lot of them that have done that over the time, and then you have this new money technique thing that I think is a bit of a problem.
Yeah, it's as old as the insurance industry because way back when there was only whole life, that's what would happen. You
Yeah,
would have rising interest rates, and the portfolio rate can't keep up, so you would freeze one block and start a new block.
yeah.
You,
Well, it's not a new trick.
it's not a new trick. I think it's when it gets to the point where you're artificially suppressing a cap in
Yeah,
order to create a more competitive new product is where I have a philosophical problem.
yeah,
But it isn't necessarily incorrect to block it off because that portfolio is being that cap is being supported by the portfolio generated by that book of business. And so it is fair if that portfolio can only support a lower cap, then that is not necessarily inequitable.
Yeah, I think so too. I do agree with that. It's
It
a challenge, I think.
Well, I think it's got to work both ways
Yes.
because every time we have this discussion, over time it flips.
Yeah.
And the one that was looking good with the new money, all of a sudden their portfolio is locked in with their duration that they have. And the old portfolio turned over, and all of a sudden it can have a higher cap. So if they're doing it pure and keeping them track like that, then that's probably equitable.
Do you think most companies are like their old blocks? Do you think, and this is totally speculation because you probably have no insight, but do you think that most of them on their old block are keeping like the profits basically to where they're like break even on the hedging and they're giving the best deal that they can for the old clients?
I would think that there is so much pressure on increasing new sales that it would be easy to rationalize putting the best investments on the new
Yeah,
blocks. I don't know that that's necessarily the wrong thing to do,
right.
but it would be a lot of pressure to do that.
Just like back when you were at the chief actuary and they wanted you to drop the dividend.
Yeah, that was a little more overt. I
Yeah,
mean, in that case,
right.
but it's different between pulling out assets from one book and moving it over here because they're the best performing
Yeah,
assets.
if
That's a
we got
little,
bonds over
yeah,
here, we move
yeah,
it. Okay, let's not put those on product one. We'll put that on product two.
yeah.
Yeah, that's a good
That
point.
I think is would. I mean, I just wouldn't. I don't have any information on whether they do that or not. It would be understandable if they did.
Yeah.
And I think it is interesting to see sort of rate history and how they do it. Some companies are better than others on that.
I mean, I saw an analysis of a company and it was like the old block was, and it seemed like the cap was really low and the old block, if because they sectioned their old block, the interest that they were earning matched the cap that they were
Yeah,
providing.
which is how you should do it.
Which is exactly how you should do it. And you're right. Like, if you're going to make new sales, which you probably need to if you're going to continue to survive as an insurance company,
Hmm.
you have to have a competitive product offering,
Yeah, these issues always come up when you have a sudden rise or
which is
decline.
exceedingly unusual. What we saw over the last, whatever, 3 years.
Yeah,
Actually, you could say that over the last, oh, well, you could say 10 years, really, because it was just slowly declining interest rates to nothing. And then like a
a spike,
straight,
right.
um, I mean, I,
Well, you're not old enough. That happened in the 80s.
this is the first time I've experienced it. How about
This is the second
that?
time for
Yeah.
me.
Well, yeah, that's a good point.
Well, and it created a lot of problems for the insurance industry back
Yeah,
then.
disintermediation or whatever.
That's when universal life just became popular, and you had whole lives stuck in the low dividend environment,
Right.
and these ULs were crediting as high, in the teens.
Yeah, yeah, and that kind of ended up being a little bit of a black mark on the industry. I mean, I remember reading like I was a kid, so I guess I was a little weird. I was reading the whatever it is, Dallas Morning News, and they were talking about, oh, my policy is lapsing
Yeah,
and things like that. I bought this UL, and
yeah.
I think I probably asked you about it, but
It was, I mean, it was literally a whipsaw because you
uh-huh,
had a lot of lapses from the old whole lives or loans from the whole lives because of the rates.
uh-huh.
And you had the inflated rate of the universal life. And then when those dropped, you got the lapses. So it was a tough time to be in the insurance business.
Yeah, I'm sure. Yeah, that's unusual. So how do you think your background with being an actuary helped your sales career? Because I guess if you think about it now, most of your career has been in sales.
Yeah, that's,
Kind of hard to believe.
yeah, it is a little bit hard to believe. I would say that most of the agents and advisors I work with were really good at selling,
Uh-huh.
but they didn't have the product knowledge.
Right.
And what they needed from me, which was easy for me to do, would be to help explain how these products work and why this product is better than this product. And that gave them the confidence to sell and know that they're selling the best thing.
I was almost going to say that it sounds like it gives them a confidence boost to know that this is backed up and this is legit's not the right word, but solid, or
Well, at
whatever.
least appropriate. That
Appropriate. Yeah,
you
that's a
know
good way to
that
put it.
I was able to do their due diligence
Yeah.
and help them with that and gave them the confidence to do that. That was probably the biggest help
Yeah.
to understand this is how they work and this is why this one is better than that one.
Yeah, no, I could definitely see that. I could certainly see that. So if you were going to like look back, and I want to ask you about your current venture, the pizza venture.
Yeah.
So looking back on your insurance career, and if you were going to give yourself advice, what would it have been in the beginning, I guess, all the way in the beginning?
All the way. Well, that's a tough one to answer because I really feel blessed to be where I'm at.
Yeah.
And I think it was an interesting journey. Uh, I might have been able to get there faster if I skipped a couple of steps, but you never know what you pick up and how it was used. I mean, being an actuary trains you how to solve problems.
Yeah.
And so solving an actual problem or coming up with a case design, similar skill sets. So
True.
I feel good about that. Probably the one thing that I wish I would have done differently, or I would have done differently, is I would have educated myself on how to leverage talent. I always felt like I had to do it myself, and I did a lot myself. Instead of hiring good people and training them to replace myself, I probably would have been a little bit more successful. But I always felt like I was the best one to do it, and
Might as
you
well be
know,
you.
might as well be me because no one can do it better than me, as you can attest to.
I can I can certainly attest to that, and I think that's really good advice. And actually, at one point, you told me your counterpart in up north,
Chicago.
Chicago, was arguably better at that.
He certainly did a better job of getting his good people in the right place, and he managed them, whereas I did most of the
You did it the hard way. He did
I did it
the
the hard way, and he learned from that. Yeah.
yeah. What do you think that is? Like, what made him know to do that, or what, and you maybe didn't, I guess.
I'm an actuary, a little more introverted, and
Yeah.
he likes people. I don't.
Yeah, maybe so, because you did have like I don't know what his career was, so I'd have to ask him, but I guess that's a different path maybe,
Yeah,
and he had the maybe more of a sales background and knew, okay, well, I got to multiply myself to
yeah, that
grow.
definitely. Yeah, that. Yeah, that would be one thing that I would have done differently. It just never worked out that way, and
Yeah.
but
Well, it's not
that's I
like you didn't
think
have any other salespeople. They just, I guess, weren't as good as you.
unfortunately that's true.
So So you have advisor's resource, and then you have also this trust company that you've always had. It's always just been sitting there out there, and it's starting to grow. Wealth Advisors Trust Company.
Yes,
And
it's
you
doing
did
really
a
well.
brief stint as the president of Wealth Advisors Trust Company.
Yeah,
So again, chief or actuary, BUL wholesaler for Penn Mutual, uh, foreign national
yeah,
program, chief actuary, regional director, I guess small business,
all right.
be agency owner, whatever you want to call. And then you have this trust company. You're the president and the head of sales. What was that
Yeah.
like?
Well, the president was a name only. So that was
That
yeah.
seems to be a theme with you.
Yeah, you have to name a president in South Dakota, and
Okay.
so I happened to be. It was my turn to do that, but I did help him set up a distribution arm, and I just copied what worked
Yeah.
at Advisors Resource and Penn Mutual for that matter, and that's internal and external wholesalers and put a process together to deliver the message. I mean,
So you kind of did what you said you should have done. You
exactly.
took your own
Yeah,
advice
I
in
took
that
my own
case.
advice and I hired good people, and just last year transferred the reins to Aaron Roby, who used to work for me when I was at Penn Mutual.
Yeah, that was a
And
long time ago.
yeah, so he's doing a good job, and
Yeah,
it's starting to work. I mean, I heard a long time ago, sales is pretty simple, and it's never seen, never told, never sold.
that's right.
And you got to see people and tell your story before you'll ever make a sale.
Yeah,
And so if you stick to that, then it's all about who you're talking to and what you're saying. And so
that's
you just perfect those things, it'll work.
yeah. I can't tell you how many times I talk to an advisor and it's just like, well, you gotta like, I mean, you gotta just go see the people and tell them something. I mean,
Yeah,
first figure out who you're gonna talk to, and if you're not doing that, then I don't know that I can help you. You know, I
it
mean,
is pretty
not
well.
that complicated.
Yeah, it's hard to do consistently,
It is, yeah.
and it doesn't make it easy, but it isn't complicated.
No, it
The
does.
formula
Yeah,
is
yeah,
it's like uh, it's like Gary Kinder.
yeah.
There's no secrets.
No,
The secret to success, there's no secrets. You just have to do the work.
that is the secret.
And
There is no secret.
yeah, once you figure that out, then it becomes easy.
Yeah, it's just simply visiting the people and talking to them. So you have the Wealth Advisors Trust Company, and now you're, I guess you don't have a, well, you're a part owner of it, so
Right,
you're
right.
somewhat involved still, but it's not like a day-to-day job there anymore.
No, we're there's five owners, and we are in the process of hiring a true president, not a
A
real
real
one,
one.
and we've got a good candidate, and that puts us more on a board capacity
Yeah.
to where we will just have probably monthly board meetings, and then of course twice a year we have to go up to South Dakota for board meetings.
Are you gonna move to South Dakota?
No, no, no. It's a good place to visit. Rapid City is a nice
I need
city.
to go. It sounds great.
Yeah, yeah, but no, I wouldn't want to live there. It gets pretty darn cold.
Yeah, summertime's probably the best time to be there.
Yeah, yeah,
Yeah,
it
especially
is.
from Dallas. I mean, it's already. I think it was 100 yesterday. I don't know what it's going to be today, but
Yeah.
yeah, that's brutal. So now you're, I guess, somewhat part-time with the trust company. Now you've got a pizza franchise,
Yes, yes, we
Donato's.
do. Donato's Pizza franchise.
So what about your actuarial experience equipped you to run a franchise?
Well, I had the money. That was that was one thing. Uh, well, the idea was, as you know, your brother Travis was working here, and
Yeah,
I could see that wasn't gonna last forever.
yeah,
And he has a passion for cooking,
yeah.
and so we thought it would be good to set up a franchise as a alternative source of revenue, and maybe that's something that he could do. It has not turned out to be that a source of revenue. In fact, it's a big source of expense.
Well, it's
And
hard. I mean, new business
it is,
is tough.
you know, some of the experience that I've had with the trust company and EOS
Yeah.
is all about people and process.
Yes.
Donato's has a great process, but we still have to hire the people, and
Yeah.
it takes a while to hire part-time kids
Yeah.
and young individuals
It's just
that
a totally different thing.
it's a different mindset, and so getting used to the type of person that would be successful in
Yeah.
that is different than what I'm used to. And
Yeah.
so you go through a lot of turnover, and we're getting close. I think once we get that fully staffed and you get into a rhythm, it'll be successful.
Yeah. I was just reading, I'm actually reading it again right now, the E-Myth. And one of the interesting facts about it, I'm gonna probably get it wrong, but it'll be close enough. It's like 75% of new small businesses fail,
Yeah,
but like nine in within 5 years or whatever the stat is, but 90% of franchises where they have all the systems laid out,
yeah,
90% of those survive after 5 years.
yeah, yeah.
So that should tell you something. I mean, I had Wade on a couple weeks, oh, actually probably a couple months now, and he talked about this, like the systems that they put in place and
Mhm.
the processes really matter.
It, it's incredible what they've figured it out. You know,
Right.
their KPIs are down to, you know, if you could just watch these three numbers, you'll know if you're successful or not. So it gives you early indicators, and it's just a matter of the execution part, which is all about people.
Yeah, I think that's really important for advisors, agents, whatever you want, the people that we work with to remember because, you can kind of go through and it's like all chance, like I run into this guy and I sell him a policy or whatever, but you have to have some sort of metric that you keep
Yeah,
track of, right?
yeah, definitely.
And we have metrics, but the franchise thing, shortcutting the process to because if you were to open a pizza franchise or a pizza store, you'd have no idea what metrics to follow.
You wouldn't, and you wouldn't come up with these, and these are through years of experience. It's been a franchise been around a long time. Probably one thing that helped me so far is the concept of the one thing.
Mhm.
Because when you open up a new restaurant and you're going to have probably 15 problems,
Yeah,
but there's only one problem that's the biggest.
right.
And so you got to focus on that. And so just focusing on the biggest problem, solving that, which makes the next problem the biggest, and you solve that. Once you get through three or four of your biggest problems, then it's fine tuning.
That's a really good point. That's a good book. I need to probably go back and reread it because it's easy to make a millimeter of progress on a million things,
Yes.
or it's not easy to do that. It's still hard to do that, but it's not as impactful as
Well,
if
but
you.
most people, when they have 15 problems, they'll say, which is the easiest one to solve?
Good point,
And yeah, you can get that one solved, but
but it's not going to
that's,
move the needle.
yeah. So which one moves the needle the most? And that's really how I approached it. And that's been helpful. Now I'm down to, okay, we've got to tweak some positions and
Yeah,
get the right people in the right seat.
yeah. Well, you guys just opened
This
December
December
2024.
17th. Yeah.
Yeah, so it's been and ironically, it's in the town that I live in, which is just next to where you live,
Yeah.
Coppell.
Yeah.
Um, so I have a lot of like my kids' friends, parents that go there all the time. So it's kind of like funny.
Yeah. Yeah. It is. I think it'll be fun
Long term, yeah.
once we get everybody in place. Right now it hasn't been that much fun, but
Yeah.
it'll get there.
Well, it's like anything, you got to get through the headaches, I suppose.
Yeah.
So I really appreciate you sharing your insights. I don't know if you had anything else you want to add besides what we already talked about or any other thoughts.
Just that I think the life insurance profession is one of the best businesses there
Yeah.
is because of the impact it has on the families that you work with. And I'm so glad and blessed that I was in an industry that helped so many people.
Yeah.
And so if, to anybody that's out there doing that kind of business, it's a noble business. I really feel strongly about it. And it's a great product when used appropriately.
I agree completely. It's one of the best industries to be in, and you can have a significant impact, and it's even you can directly see it
Hmm.
to the people that you
Yeah.
help.
Yeah.
So I really agree, and I appreciate you coming on. I appreciate all your
No
insight.
problem.
It was fun. Thanks everybody. Thanks for joining. Hope you guys enjoyed, and I think Maddie will put the contact information in the description. And feel free to reach out if you have any questions. Thanks.